In this video, we give you a preview of our Third Thursday YouTube series and some social media videos that need to be discussed. Let's get started.
Let's get some money.
From New Money, New Problems, it's the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. Negotiating compensation, purchasing your first investment property, helping your family with money, the highs and lows of entrepreneurship. New money brings new problems that require new solutions. Join us as we work through them together. I'm Brenton Harrison, and this is the New Money, New Problems podcast. Hello, and welcome to another episode of the New Money, New Problems podcast. I will tell you that I am tired, and this week, today, I really got bit in the butt by life, and I'll tell you why. I had grand plans for this week in terms of what we're going to do for our podcast content. On our unrelated Escape Student Loan Debt podcast, we released an episode fully discussing and covering the new repayment assistance plan for federal income-driven repayment plans. And if you have those loans and you have an interest in the new plan that will be available in the middle of this year, I highly encourage you to go to that platform. We'll put a link to it in the show notes so you can figure out whether it's the right plan for you or whether you should stay put with where you are currently with your IDR plans. But it took a long time to go through that episode, and I have a terrible habit of recording podcast episodes due to be released on Friday on Thursday evening. So I was up until probably a little before midnight editing that episode, and what I planned to do for our episode on New Money, New Problems was to release the recording of our Third Thursdays session on YouTube. So every third Thursday of the month, 6 p.m. Central Standard Time, I get to be a little petty. You know, I'm typically not one who spends my time making content based on other people's financial content. But on third Thursdays, I do take the opportunity to find some videos online when it comes to finances that need a little more context and complain a little bit. And I do think the complaints at least are valuable information for you to know. And I was planning to take last night's recording and release it or a snippet of it on today's podcast. For some reason, I haven't been able to download that video. So I was editing till a little before midnight, and now because I couldn't release that snippet, it is 5 a.m. on Friday morning, and I am releasing or recording the episode that will be released today, Friday morning. But I wanted to show you some of that content from Third Thursday. So what I'm going to do is I'm going to play you some of the videos that we discussed on the channel. I'm going to put a link in the channel to the show notes. If you are not subscribed to our YouTube channel, I highly recommend it. And we're still going to go through some things that I think are valuable to know. These are all social media trends that were either sent to us by some of our people in our community, by our staff, or in this case, my wife, her first entry into the Third Thursdays program. So let's look at a video from TikTok on the IRS customer service, the status of their workforce, and I want to use this to introduce a concept called safe harbor payments.
Buckle your seatbelt because the IRS just put out a warning for people filing taxes in 2026. You see, this tax season, the IRS has 27% less employees than they did last year because of the DOGE cuts. On top of this, the IRS also fired their largest technology partner, and all of this is coinciding with massive tax changes because of the One Big Beautiful Bill. Because of all these changes that impact seniors, students, children, and families, the IRS is scrambling, and it's taking them a little bit longer to help people get refunds and process returns than usual. Reports are already coming out from the IRS saying that they're only picking up 66% of calls that are coming through, and those people who do call the IRS have to wait about 45 minutes to an hour in order to get a hold of someone. The IRS is also leaning a lot more on electronics, which is important to note because if you do make mistakes on your tax return this year, it will get flagged and you could be receiving a delayed refund. All this to say, make sure you do your due diligence in filing your taxes this year and do it the right way. If you need help with filing taxes, comment the word tax refund and I'll set you up with one of my partners.
All right, this creator is spot on. While we don't necessarily know the exact number, I don't think we know the exact number, it is true. that the current administration has been laying off people from the IRS in droves, and as a result, it is leading to extremely long wait times. It's leading to delayed processing times. It's leading to a whole host of issues when it comes to people filing their returns, and if they are owed a refund, getting that refund back. Now, the thing that this is interesting that opens up in my mind is a concept about safe harbor payments, because there's a possibility of you getting a refund, of course, but there's also the possibility of you owing when it comes to a tax return. And to me, that opens up the conversation about safe harbor. So what is safe harbor? This is something that is very relevant to people who are in one of the following categories. If you are a business owner, for sure, but also if you're a W-2 employee that gets bonuses and or equity compensation. Why is it relevant? Well, when it comes to the W-2 employee, we've covered many times on this podcast that if you're a high income earner and you get bonuses, you have to be careful about the supplemental income tax rate. And what that means is for supplemental income below $1 million, the default rate for withholding for taxes is 22%. If you don't talk to your employer or whoever has the investments for your equity compensation, your employer's default rate that they're going to withhold for federal taxes is 22%. The problem is if your marginal tax rate is higher and it's 32, 35, 37%, then there's the possibility that they under withheld by 10, 13, or 15%, and it can lead to some significant and unexpected tax bills. If you're a business owner, then you might be the type of business owner that's not on salary. Maybe you have an LLC, and the amount of income that you receive is not taxed. You have to take care of the taxes on your own. You don't have a W-4 where there's some employer above you that's taking care of it for you. And for all these reasons, people in these camps often have to send in quarterly tax payments. So every 3 months you send in a check based on an estimate of what you think your taxes would be in terms of what you owe throughout the year. Now, the interesting thing about this is the IRS wants the amount of money that you owe them throughout the year, but they don't want it all at the end of the year. They want you to give a certain amount based on what you would have owed every single 3 months. And if you choose not to pay them based on what you should owe throughout the year every 3 months, you could be charged an underpayment penalty. So for example, if you owed $40,000 in taxes and you pay $10,000 every 3 months, then for that $40,000, they take your money. You wouldn't have any underpayment penalties. But instead, if you waited until the end of the year and paid $40,000 at once, they would charge you an underpayment penalty because they didn't get your money as you made it. And that's where safe harbor comes into play. Safe harbor allows you to use two different calculations to determine what you can pay throughout the year without being charged an underpayment penalty, because all of this is kind of a crapshoot, but hopefully an informed crapshoot. If you're doing proactive tax planning while you don't know exactly what you're going to earn, you can do some projections that can keep you safe. So what are those two calculations? Well, the first is if you look at what you owed from last year's taxes, in this year, you can base your quarterlies off of 110% of that number. So for example, if you paid $20,000 in taxes last year, in this year you can base your quarterlies off of $22,000, and you can break that up into 4 equal payments. Now, when would you pay the 110% number? You would pay the 110% number if you think that your income for this year is going to, at worst, stay the same and likely to increase. So if that $20,000 in tax was based off of an income of $150,000, and this year you're projecting to make $175,000, you would want to go off that 110% number because you're probably going to owe more in tax in the next year. And the great thing about that 110% calculation is if you use that number, $22,000, it doesn't matter if you actually owed $50,000 in taxes in that next year. As long as you paid that 110%, they're not going to charge you underpayment penalties. That's option one. Option two is if you had a significant income in the year before that you don't think will be replicated. So let's say that you got a bonus that was larger than usual, or you sold an asset for significantly more than what you have planned to sell in 2026. Whatever the reason may be, if you don't think you're going to earn this year what you earned last year, instead of using 110% of last year's taxes, you can use 90% of this year's taxes. Now, this requires a lot more active planning because because you have to have an eye on what you're earning in real time to use that 90% number. But there are people in this scenario where they know, look, I got a huge bonus last year. That ain't happening again. I got a sign-on bonus for this job. That ain't happening again, or at least it's not happening this year. They'll choose instead to use that 90% number. However, if you're asking me what's safest, the safest and what you'll see most people do are two things. The first is if you overpaid in the year past. So let's say that you owe $20,000, but you had paid in $25,000. What many people will do is instead of taking that $5,000 refund, they'll apply it to the first quarterly payment for the current year. So you're essentially getting $5,000 ahead of this year's quarterly payments. Unless you're starved for cash, that makes sense because the first quarterly payment for the year is due on April 15th, and so are taxes. So it's one of those things where it's like instead of waiting for a significant period of time, like they said in the video, for them to send me my $5,000 when I owe quarterlies today for the current year, I might as well just apply it to this quarter's payments, and it will decrease how much I owe for the remaining 3 quarters. The second thing that people do that I think is wise is never going off of the 90% rule to start, and instead using that 110% number for the first 3 quarters, and then in the last quarter of the year, either by themselves, if they're adept at tax planning, or with their tax professional, actually look at what you earned, and if you have overspent because you're not going to have a banner year, then you can always knock down to that 90% number in quarter 4. So essentially, if you overpaid for the first 3 quarters, you may have little to no quarterly in the 4th quarter if you're knocking down to that 90% number. So put your refund ahead instead of receiving it in cash is option 1. Option 2 is always start with the 110% and take that money off the table in quarter 4 if it's relevant. All right, lastly, let's go through one that is a video that to me is like the perfect example of social media financial content, where it gives you something that sounds really, really appealing without giving you any of the context as to who can use this and how unlikely it may be. Let's take a listen.
If you're married to the right person, you could literally save $60,000 on taxes. Being married is a financial cheat code. Here are 4 lethal combinations for couples. Welcome to episode 6 of Oversharing Our Finances. As a DINK couple and startup founder couple, I love talking about our finances so it can help inform your own. Number 1 is the W-2 earner and the founder. This was me and Nick at least a couple weeks ago. His salary, at least at the very beginning, was able to cover our rent, and his health insurance covered for the both of us. Any startup losses that I had at the beginning of my journey also contributed to deductions in our tax bill. Number 2 is the W-2 earner and the real estate investor. If the real estate spouse qualifies as a professional, their property losses wipe out the working spouse's taxable income. Couples can save $60,000 a year doing this. Number 3 is the W-2 earner plus the freelancer. One can max out a 401k and the other can create an SEP IRA or SEP IRA. You are sheltering double what 2 regular employees ever could. Number 4 is the high earner plus the non-working spouse. Filing jointly drops your tax bracket and saves roughly $6,000 a year. This is helpful if one of the spouses wants a little bit of a break. The non-earner can still build retirement savings through a spousal IRA. I love breaking down personal finances as well as couple finances because me and my husband are building a startup to $1 million. If you have any questions about how to set this up, comment below. If you want more content like this, follow for more.
Man, I tell you, this type of video gets my blood boiling. And the first reason why is, why on earth would you feel confident telling someone you can save up to $60,000 without giving them any explanation as to how you got to that number? That is the most random, arbitrary number to tell someone that they can save in taxes. And the other reason it makes me upset is because you're releasing this video to people of all incomes, right? There's probably somebody watching this video who earns $400,000 and maybe they could save $60,000 based on your just hidden calculations. But there's also somebody watching this video who makes $100,000. And I can almost assure you that you're not going to be able to save $60,000 in taxes. If you make $100,000, you may not even owe $60,000 in taxes. It's just so arbitrary. But in addition to that, there's a lot of context missing from this video where she's not exactly saying things that are incorrect, but she is not sharing just how much you have to earn to be in a position to benefit from these maneuvers. Let's go through the 4 categories that she mentioned and give a little more of that context. The first type of couple she mentioned is a couple where one of them is a W-2 employee and the other is a founder. And what she was saying is they can use the startup costs that are operating at a loss from the founder to reduce the amount of income the W-2 pays on their taxes. That is accurate in theory. What she's basically saying is when you have a business, you can take tax deductions that will decrease the amount of revenue or net income for that business on your tax return. And in startup years, or any year really, if your expenses are greater than your income, you can actually show a net loss on that tax return. And a net loss on a tax return for a business, that's what's called a pass-through entity. The business return or income passes through to your personal return. So if you have a W-2 employee that earns $200,000 and their spouse had a net business loss of $50,000, then it reduces their income on their tax return from $200,000 to $150,000. Now, the thing that I think requires more context is, number one, do you get into business to show a loss? No. And I don't think that's what she's implying. To be clear, she's saying that if you happen to have losses, this is something that could at least benefit you from a tax return while you're getting your business up and running. But if you do this as a tax strategy with intention, meaning there's somebody who's watching this video and might open up an LLC and just intentionally show losses so they can net out other income. This is something that I have seen happen. This is not me speculating. There are people who start LLCs because they're on LLC Twitter and they just see, oh, I can start an LLC, I can buy a whole bunch of stuff and I can deduct it. Well, if you do this and you don't actually try to make a profit, you could run afoul of something called the hobby loss rule. And the hobby loss rule is basically the IRS saying we are not going to allow you to just have a business, not try to make a profit, and take losses on this business year after year after year. If you do that for more than 2 or 3 years, you might run afoul of the hobby loss rule, and they may say this is not a legitimate business. Thus, these are not legitimate tax deductions, and we're going to make you pay us back for the taxes that you saved by having this illegitimate business netting out other income. Number 2, they talked about W-2 employee with a spouse who has real estate professional status. And to understand why this is valuable, you have to understand the rules when it comes to passive activity losses on a tax return. So there are active activities. Active activities will be something like you going and working a job and getting an income for that job. Then there's passive activities where you have an investment that may be earning a profit or it may be experiencing a loss, but it's not something you're doing actively throughout your day. It's a passive investment. Well, when it comes to active income, like starting a business, you can use the losses from that activity to net out income from other sources, as we just discussed. But when it comes to many passive activities, you cannot use those losses to net out other income. You're stuck at zero. So if you have a passive activity like a rental property, for example, and you have costs when you buy that property, you have to buy a new HVAC unit, you have to pay a property manager, you have to do all this to get your tenants in the property, you have to repaint it, get new carpet, and in the first year you technically lost $10,000 on that property. Well, you can't show that on a tax return. It's just going to be stuck at zero and it can't net out other income. However, there's a caveat for people in various situations. One of them is for a short-term rental. So for example, if you have an Airbnb property and the average stay in that property is 7 days or less, you may be able to have an exception for the passive activity rule. Now, it doesn't mean that nobody can stay for longer than 7 days. It just means that the average stay has to be 7 days. And there's more attached to that rule. So we'll put some links to that in the IRS database in the show notes, because again, I'm not a tax professional. So if you're trying these things, don't just listen to that, go buy an Airbnb and think that you can do it. You need to consult with the tax professional. But the other exception, or one of the other exceptions, is if your spouse is a real estate professional. But that's not something that you can just declare yourself a real estate professional. It has to be something that will stand muster. So what we're going to do is we're going to pull up the IRS definition of a real estate professional so you can see that this is not an easy bar to hit. Straight from the IRS database, you are considered a real estate professional if more than half of the personal services you performed in all trades or businesses during the tax year were performed in real property trades or businesses in which you materially participated. This is saying that you cannot say, oh, I'm a part-time real estate professional. You have to prove that you are spending more than half of your time working throughout the year in this trade. So if you have a day job and on the weekends you're going to do real estate, doesn't count. You have to be doing this for the majority of the year. And you also, it's not either or, you have to meet both of these requirements. Says you must have performed more than 750 hours of services during the tax year in real property trades or businesses in which you materially participated. So if you're keeping track, that's over 60 hours a month that you have to prove you spent in the industry. So again, is it possible? Sure. But this is not something that you can casually do. So when she talks about W-2 founder and W-2 plus real estate professional, and to me kind of implies that you can just go get that status, you can't. You're basically saying the person that's the other person in this relationship is a real estate professional. This is not just a tag that you can go and get. And to me, that's a little lacking in context. The next, she says W-2 plus freelancer. So in order to do what she's saying, where the person who's in the W-2 can max out their 401k contribution and the person can max out their SEP, they're essentially saying that yes, this is possible, but the couple in this scenario has enough discretionary income that they can max out a $20,000 plus 401k contribution and afford to put up to 25% of their business profits in a simplified employee pension IRA. Again, if you have the cash flow to do it, this is a great video to watch. But does the average person watching this video have the capacity to have one person working a W-2 job and put aside that 20,000 plus, and then have the second person on a freelance income set aside 25% of their pay? I would say not. And lastly, and this is not something that's inaccurate, it's just something that is again lacking in context, and ironically, based on some of the terminology that she used, it's actually more unlikely that the person will be able to take this step. She talks about the high income earner W-2 and a spouse who doesn't work at all outside the home. Not saying doesn't work at all, I'm saying doesn't work at all outside the home, so please don't take offense. But this is something where she brings up the concept of a spousal IRA. And to understand what that means, individual retirement account is what an IRA is. And with an IRA, you can only contribute the lesser of 100% of your pay or the annual contribution limit for the year. So for example, if the annual contribution limit is $7,500 and you earned $100,000 this year, well, you can't contribute $100,000. You'd be stuck at the $7,500. But if you only earned $1,000, then you can only contribute $1,000 to an IRA. You can't contribute more than 100% of what you earned. For a stay-at-home spouse, that's troublesome because if you didn't earn any money, at least based on your own income, you can't contribute anything to an IRA. But that's why there's a concept called a spousal IRA where you can use your spouse's income to justify your contributions to an individual retirement account in your name. And if you're not a stay-at-home spouse and this doesn't seem like a big deal, why would you not just put it in the spouse that's working's name? Well, a stay-at-home spouse will tell you that it is somewhat daunting to have given up your career aspirations, your ability to save on your own, and have your retirement picture wholly dependent on your spouse and all of your investments in your spouse's name. You may want something in your own name for your own investments' sake. That's why spousal IRAs exist. However, when she's saying that the high income earner gives the spouse the ability to open a spousal IRA and contribute, that may not be true because there are certain limitations as to what can be contributed based on the income of that spouse and whether they have access to a retirement account at their employer. I have pulled up on the screen the 2026 tax tables for the Certified Financial Planner exam. These are distributed to all the people taking the test as a guide when you have tax questions and things of that nature. And it gives you all of the current guidelines, contribution limits, phase outs for the current year. And if you're looking, you're going to see a section called IRA deduction phase out for active participants. An active participant is someone who has access to a retirement account at their job, whether or not they use it. So even if you don't participate in your company's 401k, if you have access to one, you're an active participant. And you see as a subset, spousal IRA, and it shows $242,000 to $252,000. What does this mean? Well, It means that if you are trying to open and contribute to a spousal IRA for your stay-at-home spouse, then if you're an active participant, you have to pay attention to your adjusted gross income. If your adjusted gross income is below $242,000, then your spouse can max out their contribution to a spousal IRA. But if your adjusted gross income is between $242,000 and $252,000, they can contribute to a spousal IRA, but they can't contribute the maximum. Their amount is reduced based on where they are in this $10,000 range. For example, let's say that this household's adjusted gross income is $247,000. So they're literally 50% of the way through this phase out range. Well, instead of being able to contribute the full amount to a spousal IRA, their spouse would only be able to contribute 50% of the contribution limit because that's where they fall in the range. It's reduced. Now, if their adjusted gross income is above $252,000, then their spouse cannot contribute to a spousal IRA this year at all. So ironically, she's advertising that a high income W-2 employee has a spouse who can contribute to a spousal IRA, when in fact a lower income W-2 earner would be more likely to have a spouse that can contribute to a spousal IRA, because if their income gets to a point that's too high, their ability to do that goes away. All in all, on some of these videos, there's a little bit of truth, as I shared, but in most of them, there's a lack of context, in some cases, a dangerous lack of context that just reinforces the point that while you can possibly find accurate information online, you don't want to cross over the threshold of taking what may be accurate information and then using it as a recommendation for what to do with your money. Go the extra step, verify your own details. Don't be swayed by clickbaity material like how much you can save on taxes because it's up to $60,000 according to this person. This is my only outlet to get a little petty. So I hope that you will allow me that on this Friday morning, but also understand and appreciate that this context that I've shared can add value to your finances. And I hope to see you right back here next week. From New Money, New Problems, this was the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen.